If you are an investor, it is crucial that you discover the best way to purchase bonds. A well-diversified investment portfolio should contain a balance between stocks and fixed income. This method allows you to avoid volatility while pursuing development on your own terms. Financial management is comparable to the upkeep of one's favorite and most beautiful classic automobile. It would be beneficial if you modified it using an appropriate set of tools. The right understanding and basis of financial management enables you to create the investment portfolio that ensures your future success. Developing a thorough grasp of bonds is crucial to your financial education in order to acquire fundamental investing knowledge. Let's go into the science of investing in government bonds to provide you with a straightforward approach to the subject. Be sure to stay tuned until the end. What is an official bond? Government bonds are sovereign bonds or debt obligations issued by a country's government. They are often a sort of government-issued security. Each year, the government gets a certain sum of interest on the bond, constituting a fixed income security. If you want to establish a well-diversified investing portfolio, you will need a firm grasp of both the stock market and government bonds. If you want to reduce possible investment risk, you will need a stable income stream from investments other than equities. Government bonds will supply this continuous income stream. The objective of the bond. The government issues bonds to collect funds via a predetermined rate of interest that will be used to fund government operations and pay off obligations. This debt is issued in the national interest and is used by the government to get help with government expenditures. What are the various bond kinds according to the issuing agencies? There are typically three distinct kinds of bonds, depending on the issuing authority. Corporate debt. These bonds are issued by both public and private companies. These bonds are debt instruments that are typically offered for $1,000 par value. Typically, these bonds are offered with variable coupon rates and maturities. Corporate bonds constitute a large portion of the U.S. secondary bond market, which is dominated by U.S. government bonds. Municipal bonds. These are the forms of debt instruments issued by states and other local government bodies, such as towns and counties. Typically, these bonds are issued to pay for public projects and everyday operations. The two primary forms of municipal bonds, or munis, are as follows: general obligation bonds, revenue bonds, conduit bonds. Purchasing municipal bonds has a minimal amount of risk, but is not entirely risk-free. The agencies may not disclose the agreed-upon interest amount. Due to their reliance on the federal government for funding, these organizations cannot create money and hence pose a greater risk. U.S. government bonds. The U.S. Department of the Treasury issues these bonds on behalf of the federal government. This is the most popular and secure investment strategy backed by the federal government's confidence and protection. There are four primary types of U.S. Treasury securities: government bills with a maturity period of less than 1 year, government notes with a maturity period between 1 and 10 years, government bonds with a maturity period of more than 10 years. Treasury inflation-protected securities, or TIPS, offer a variable interest rate based on the inflation rate issued in terms of 5, 10, and 30 years. Why are government bonds thought to be safe? It is very improbable that the government will fail in its obligations. Thus, a buyer of government bonds may feel confident. Aside from this, government bonds have lengthy maturities. The maturities range from 1 month to 30 years. Who issues government bonds? The United States federal government or one of its agencies issues these bonds. Local government agencies' bonds are referred to as municipal bonds, and they are seen as less safe than federal government bonds. The benefits of bond investing. There are typically three motives for purchasing a bond. One is to create a reliable income stream. This is the primary reason why investors want to purchase bonds. The bonds offer investors a stable income stream. Another reason is lower risk. There is a guarantee that you will receive the bond's coupon payments. As a result, investors know when they will get the predetermined amount and how much they will receive. This also implies that future obligations, such as college tuition and retirement, are covered by the bond proceeds. Finally, higher returns. Typically, investing in bonds is advantageous, since it may offer better returns than comparable duration bank deposits. An obstacle to the inflation rate. Another incentive to invest in bonds is that they might act as a buffer against inflation rates. Thus, if you have chosen an appropriate bond, it may help you generate an investment return that matches or even exceeds the inflation rate, thus protecting you from the effects of inflation. Realization of gains and losses on investments. There is a potential that the price of bonds on the bond market may grow or decline above or below the original purchase price. Thus, the realization of capital gains and losses is simplified. The risks of bond investing. Interest rate risk. The value of a bond is susceptible to fluctuations in the interest rate. Face value, or the price of a bond, is inversely proportional to the interest rate. Bond prices tend to decline if the interest rate continues to rise. Newly issued bonds will offer greater interest rates than older bonds, making them more attractive to investors. In contrast, older bonds with low interest rates may be offered at a discount. Inflation risk. Inflation causes the overall price increase and is a danger for many investors. Due to the fact that investors get a fixed rate of interest, a rise in prices might pose a danger to their buying power. Credit risk. Credit risk, often known as default risk, occurs when an issuer or borrower cannot make principal or coupon payments. Consequently, there is a probability of bond default. Liquidity risk. This risk comprises selling the bond at a discount due to the absence of a buyer or a ready market. With a poor credit rating, there is a possibility that liquidity concerns may increase. Call risk. There is a risk that the bond issuer may retire a bond before its maturity date. The issuer takes this action if interest rates decrease. Should you invest in individual bonds or bond funds? Bond funds provide some freedom in fund administration, but also incur bond management fees, which should be taken into account when choosing a fund. After the first trading charges, individual bonds are free for you. If you need broad market exposure, bond index funds with expense ratios of as low as 0.04% are your most cost-effective alternative. Financial experts recommend individual bonds for investors who must satisfy future obligations and need a steady income flow. Thus, you will get your principal at the stipulated period. In contrast, there is no assurance that fund investors will get their initial investment back. Ratings for bonds. Bonds are often graded according to the degree of risk they pose. Credit rating agencies assess the creditworthiness of issuing agencies, taking into account the latter's track records to determine if they will be able to repay their loan. These agencies also monitor the cash flow of the issuing agencies and predict the future economic outlook of the industry and enterprises. Based on their evaluations, they assign the agencies a credit rating or grade. Short-term, intermediate-term, and long-term bonds are independently graded. Standard & Poor's, Moody's, and Fitch Ratings are some of the main rating companies that may be consulted about the ratings of bonds. Bond ratings categorize bonds in the following groups: investment-grade bonds rated BBB, BAA, or higher; unrated speculative or junk bonds, which are low quality and high risk. How can risk be reduced while investing in bonds? Bond ladders. The best method for mitigating risk is to invest utilizing bond ladders. In reality, a bond ladder is a sequence of bonds, with each rung indicating a bond with a different maturity date. Thus, it is possible to get bonds with maturities of 1, 2, and 3 years. This protects the investor against the unpredictability of rising interest rates. The investor must seek investment-grade and higher bonds, the creditworthiness of which may assist in lowering the risk of the bonds. Investors can thus be certain that the issuing agency will not default. Allocation of investments. As is the case with the stock market, you must diversify your bond assets. As a bond investor, you must diversify your bond portfolio and strike a balance between the more sensitive and defensive government bonds and the high-yield, high-income corporate bonds. Consider both benchmark and tracking mistakes. How should bonds be purchased? You may purchase both newly issued and previously issued Treasury bonds directly at treasurydirect.gov. New bond auctions occur in the first weeks of February, May, August, and November. When should one purchase bonds? It depends on your motivations for investing. When investing in bonds near or during cyclical times of interest rates, overall future returns from a bond portfolio are anticipated to be greater. Financial gurus recommend purchasing bonds when interest rates are high and at their highest if the primary purpose is to maximize overall return. The impact of increased interest rates on long-term investments may be problematic. In this situation, you may profit by reinvesting the fund dividends at a high yield over time. If your investment horizon exceeds the tenure of the bonds, you may profit from the increasing interest rates. If you want to decrease portfolio risk and volatility, the general guideline is to shorten your holding duration. The allocation of bonds is more essential than the time of their purchase. When should bonds be sold? Bonds are excellent hold-and-hold investments. This is especially true when you own individual ties. If you do not sell your bonds, you will get periodic interest payments. It makes no difference whether interest rates in the secondary market increase or decrease. However, occasionally you must sell your bond before maturity. If you believe your bond may default, you may be required to sell it. Numerous bond fund managers sell their bonds before maturity. A relative value approach consists of purchasing inexpensive corporate bonds and selling them when their value rises. Which of these ideas appeals to you most? What else would you like us to talk about? Let us know in the comments below. And make sure to subscribe and turn on notifications so you don't miss out on any of our videos.